Hi everyone. So today we will look at this stock called Ultramarine Pigments. And I'm sorry if my voice sounds a bit dull because I've not been well today, but I thought I will, record this and put this before I sleep. So let us look at this company. So disclaimers, take this analysis for educational purposes. It's not a stock recommendation. I'm not a registered investment advisor, and I do have a position in this stock. I picked this stock a week back at 35310 rupees. So it's a very small company. It's almost 1,000 crore market cap company, which is engaged in the manufacturing and selling of two chemical products, pigments and surfactants. Also, they're in the business of detergents, and they have a IT services business. So these are the four businesses in which they operate. Currently available around 335 rupee price, 44% promoter stake. The company has three factories. It started with the first factory in Chennai, Ambattur, and then expanded in Ranipet, which is again in Tamil Nadu, and then the third one is Naidupet, which is in Andhra Pradesh. And the company is run by Mr. R. Sampath, who is the chairman, and Ms. Tara Partha, who is the joint managing director. Now, before we get into understanding business, I just want to walk you through this particular slide just to highlight, because at the end, financials are a final reflection of how the business is done, and later on we'll try to understand what, why, and how of it. So if we look at this company, whether we look at the 8-year CAGR sales or 5-year or 3-year, 1 year, we can see that there has always been very good CAGR sales growth. Like the company has grown around 14 to 17%. Forget this 1 year, but 3, 5, 8 years a good reflection. So 17 to 16, 14, 16% kind of sales growth which has happened. The PAT growth is equally impressive on 8 and 5-year basis, but 3-year basis which has not done well, and we'll see why. The reason has been because of the margin compression, especially, I mean, COVID and post-COVID, the kind of supply chain disruption and the margin compression. The same, but the kind of growth rate they have shown in the cash flows, very commendable growth rate between 12 to 21%. And the stock has given decent return with 8-year CAGR of 26%, 5-year CAGR of 12%. And because last 3 years the profit has not grown that much, even the share price CAGR has not been that much. Also, if you look in terms of the company has generated decent cash flows, and a lot of that has been given as dividend, but some capex also. And the company has been able to convert most of its PAT into cash flows. And if we look at the receivable and inventory, it looks very decent. It's a debt-free company, decent gross margins, like forget min and max, that's what shows the variability. But if you look at the kind of average gross margin 52%, EBITDA margin 20%, a 14% margin kind of business, very respectable, almost a debt-free company. So ROA number, ROE, ROC, everything looks good. And let me highlight you one more thing. The ROC, though the average looks 20%, they have a lot of asset on the books in the form of investments in certain other companies. We'll discuss about it. So if we look at the true asset, which is a productive asset, actual the ROC will be, I believe it will be more than 30 to 40%. So quite an interesting business, and still the company is hardly 1,000 crore company. So let us look more about it. Few other things. So why I'm highlighting all of this, because it reflects the character of the business. It reflects the character of the, the feature of the promoter, like what kind of, capital allocation he does, if he is able to maintain this kind of growth rate, what kind of industry it is. So if we further look at cash flow growth rate and how this number is arrived, this is a rolling 3-year cash flow, which means we take 3 years of cash flow, we take its average, because in a single year cash flow doesn't give the true picture because of all the working capital changes. But when you take a mean of 3 year and you keep rolling year after year after year, then you get a better trajectory. And we can see that this company has grown in last 7-8 years. This company has grown from almost 18 crore to 47 crore of cash flow. The ROCE has been decent, the sales growth has been decent. The EBITDA growth rate has not, and PAT has not been so decent. The reason being, if you see, there is a margin contraction which has happened. That could be reason. So consistent growth in cash flow, decent ROCE, very good sales growth rate. Without with some pressure on EBITDA. And this is what I was talking. If you look at the investment, out of the 980 crore of asset, almost 600 crores investment. This is a group investment in another listed company where they own 20%. I will talk more about it. So if you exclude, if you look at the true asset, basically the company has only 142 crore of next fixed asset. If you look at the gross asset, the company has almost 200 crores of gross asset. And on 200 crores of gross asset, the company generates almost 50 crore of profit, which means almost 30 to 30 to somewhere 40% plus kind of ROCE this company generates. Now let us try to understand how this is happening. And as I said, there are four businesses: pigments, surfactants, detergents, and IT services. Now what has happened, this left side pie chart which you see, this was the revenue composition in 2012, and this is the revenue composition is 2020. So in 10 years, if you see what has happened, pigments revenue share has gone down from 34% to 26%. However, in 10 years, the total revenue of pigments has grown from 47 crore to 129 crore, which means even though the market share has, even though revenue share has gone down, basically this business has grown into 3x, which is almost a 10% kind of growth rate. Whereas surfactants, from 50% share, this has gone up to 66%. And the 70 crore revenue is up to 322 crore, which is almost 4.5x. So though both pigments and surfactants have grown, the growth in surfactants has been higher than the growth in pigments. And then if we look at the other businesses like detergent or IT, they are almost same. In fact, IT has doubled from 17 to 34, but the detergent is almost same. So the growth rate is there in three businesses. This is constant. These two are very small, and these two are key businesses. Pigment is growing at a decent rate. Surfactant is growing at a much higher rate. And now surfactant is very, very important business for them. So this gives you a brief of, what business we can ignore. Our time has to be spent on things which matter, and the things which matter are pigment and surfactants. And hence we will keep our research focus more on pigments and surfactants. And if we look at pigments, pigments are basically, they are more into inorganic pigments, and these pigments are color, and they have products like color chemicals, you can say, where they have products like ultramarine blues, ultramarine violet, and ultramarine blue is their core product. And they make 50 different grades of ultramarine blue, and they're one of the, I think they're the biggest player in India, and globally also they're one of the biggest player in ultramarine blue. And ultramarine blue pigment, it has application in multiple areas, like industrial areas like plastics, paints. And these are some of the examples where you can see how ultramarine blue is used, in chairs, and in baskets, in foods. So these are some of the places, where this kind of product is being used. And the other ones like ultramarine violet, and there are few more products, they are more a low grade pigment which are primarily used for whitewashing and laundry applications. So multiple industries, not a single industry dependence, and caters to plastic, coating inks, cosmetics, fiber, stationery, laundry, paints, these kind of industries. The second business, surfactants. So surfactants are more used in, laundry and cosmetics and shampoo. And in surfactants, they are mainly present into two chemicals. First is linear alkyl benzyl sulfonic acid, which is also known as LABSA, which is primarily used in laundry applications. The second is alpha olefin sulfonate, AOS, which is used, usually it is used for creating foaming properties, or, wetting kind of properties. And especially with India, where there is a lot of hard water found. People love when they see foaming happening in their detergents or laundry applications. So they are key suppliers, and they work specifically more in South India and Asian countries exporting. And the primary application is more in the FMCG industry, laundry, but it is also used in construction and fire safety. So laundry use, soap use, detergent use, shampoos, cosmetics, these are some of the industries where these two surfactants, they are being used. Now, if we look at how each of these businesses have grown, so I'm giving you numbers from FY22 to FY2012 to FY22, and I have highlighted the key years just to see the kind of business transition. So if you see in FY12, they had 139 crore of revenue, which has gone to 491 crore in FY22, which is almost more than 3 times, 3.5 times, which is very decent growth. And if you see, bulk of this growth has come from pigment and surfactant. So if you see the last 5-year CAGR of pigment, it's 12%. Last 5-year CAGR of surfactant, it's 17%. Detergent is 8%, but it remains small, and it has never crossed. In fact, 10 years there is no growth. And IT, yes, it has doubled, but again, last 3-4 years, no, not much of growth, 2%. So what is important is the company has kept its focus on value added products, and that is how they have kept on improving margins. The other thing is, if we look at last 3-4 years, so again, because of the focus on value added products, the company has been able to sell more and more. And in fact, there is a 150% jump in value added products since what they used to create 3-4 years back. And they were also looking on some of the launch of pigments and surfactants, which is going to be as per the margin accretive, and they were expecting it to happen in next 2 years, which is almost around FY22. And if we look at last year, last year was a very bad year for the industry because of supply chain disruption, because the price hikes, the freight cost increase, the raw material cost increase. And despite of that, the company was able to do decent because of the extremely good performance of surfactant division. The other thing which has happened is last year they did a decent capex, and that capex went live, and that is why you see from a 312 crore of revenue in 21, they did almost 491 crore of revenue in 22, which is almost a 48-50% jump. And this happened because of the kind of greenfield expansion which they did, and it was a premium grade pigment. So other thing is, pigment is still growing. So though the market share has gone down from 34 to 26, still it's a growing business, is 12% CAGR, which is decent. And surfactant is doing extremely well. In fact, at this point of time in FY21, they are working on almost 100% capacity in surfactants. And then the new capacity came, and again, more capacity is coming. And if we look at FY22 this year, so first, improved volume in pigments, and sulfonation is basically surfactants division. And the new commission plant went operational, and that is why you see a big jump in surfactants from 184 crore to 322 crore. And despite of the cost raw material, of course, the margins have gone down, but the company has been able to do decently. And also this new capacity which came for surfactants, because of the high depreciation and the high interest charges and all, the profit looked poor, which means there's a possibility of operating leverage coming. But what is more interesting is the company has more capex plans, and some of the capex will come live this year itself. Like there is a 21 crore capex which is coming in specialty chemicals in this year, which is to cater for cosmetics, personal care, and healthcare. Also, they are going to come up with something like mixed metal oxide, another product with a capex of 24 crore. So almost this 45 crore capex will be coming live in this year. And they have another proposed capex plan for pigment for 62 crore, which may come up in next 2 years. So almost 100 crore of capex lined up in next 2 years to and if you see, the company has a gross asset of 200 crore and a net asset of almost 150 crore. So almost on a 200 crore gross asset, this is going to be a 50% asset addition, which means there is enough room for profitability and top line growth and all. And we know the company works almost on a 40% return on capital. So if this new capex works even on, let's say, a 30% kind of return on capital, and we've seen they have done almost 500 crore of revenue on 200 crore of gross capital, which on the gross asset turns is 2.5. If we look at the new net asset turns on 150 crore, this is almost 3.5. So this kind of 100 crore of capex can do somewhere around I believe somewhere around 250 crore of turnover. So based on that, out of that 250 crore, I have been very conservative, and next 2 years with a 10% growth rate, I have assumed this number to reach somewhere around 610 crore. So if we try to build this thing in terms of valuation, 2 years down the line, 610 crore kind of top line is possible. Maybe 4 years down the line, 700 kind of top line is possible. The other thing is, if we look at the historical valuation in terms of EV EBITDA, the average EV EBITDA has been 8.2 for last 10 years. But look at the journey of the company. I mean, from such a small company, the company has become, 3x, 3.5x. The margins have improved. The company has shown consistency of, that kind of margin for last 10 years. They have shown consistency in terms of growth. The debt-free balance sheet is totally debt-free. So considering all of this, I believe, we cannot take all the historical data. I mean, we have to see the transition in the business. We have to see the scale growing. So I believe 10 times kind of valuation could be very reasonable. And on a 610 crore, which is the 50% capacity utilization of, all the new coming capex, at 610 crore of revenue, if we give 22% kind of, EBIT margin, because the core, I am taking only the core business EBIT margin. I am not taking the other income. So on a 22% has been average, I'm taking this 22%. The EBIT comes around, 134 crore. And given, a 10 times valuation on this EBIT with all of this, it looks like a 1340 crore of valuation. And the current market cap is 977 crore, which means, there is a possibility of 17% CAGR. Now, what is interesting here is, we spoke about the investments in this company. They have something called investments on their balance sheet. Basically, why this investment? So there is a history. So this company belongs to the same group which owns another company called Thirumalai Chemicals. And Ultramarine holds 20% stake in Thirumalai Chemicals, and Thirumalai Chemicals holds some decent stake in Ultramarine. So basically, it's a equity position. And if we look at the valuation of Thirumalai Chemicals, it trades somewhere around 2600 crore market cap, and given 2600 crore market cap, 20% stake comes somewhere around 500 crores. So that is how this 595 crore comes. But assume it's a it's a promoter holding. You give a holdco discount. After giving the holdco discount, let us say you add 250 crore of cash. Let's say if they sell it, and that 565 crore will be worth at least 250 crore. So if we add that 250 crore with 50% discount, then the same 17% CAGR becomes 28% CAGR. So I'm just trying to give you different ways to identify where, at least to me, the valuation looks quite reasonable if all the capex planned come live and they keep on delivering. Now, in terms of risk, so there is a raw material cyclicity risk, which we have seen that in last year, because of the supply chain disruption, the margin came down. But this has been an odd year. Else, if you see, the company has been doing really well. They have been improving the margins year after year, and that is why I quite like the business at such a small scale. Usually the small size companies, they are very volatile. The performance, I mean, we have known what has happened in the market in the last 10 years. Not many company can show this kind of consistency in improvement, except last year, where the best of the companies have taken some kind of margin beating. Second thing, there is a shareholding liquidity, because this is a very, very small company, 1000 crore market cap company. So somebody, it might be within the few hands, but if some people sell, even with a 2 crore of sell off, The stock can fall by 20%, the stock can rise by 20%. Third, there is a related party selling, and many times it is coming as promoter selling. Many people are confused that promoters are selling. So promoters who run the business, they are not selling, but somebody who knows the promoter from the family, they are selling. And that is another reason why the stock has been in pressure. I've been tracking that data. My sense is that selling is maybe close to getting over, because if you track it closely, who is the guy selling and how was his position 2 3 years back versus now, my sense is that selling may come to an end in next few months or quarters if they keep it. Fourth is information availability. Why I'm keeping it a risk? Because the company doesn't do any con call, they don't come much on TV, there is not enough research available, so a lot of effort has gone in putting this information. But if something good or bad happens, it's very difficult to get information in such kind of companies, so I consider risk. Fifth, size and scale. Because the company is smaller companies are more susceptible to recessions, negative scenario, economic down cycles. However, the company has shown tremendous potential and tremendous execution. Next is competition in margin, because all these products, if you see, there are other people, there are other companies also which makes this product. And let's say if some big company gets into this business, of course it can get competitive, with because the financial economics looks very good. The next is the low industry growth rate, because when I see the growth rate, a lot of these products are being used in detergents and all of that. And when I look at the growth rate of detergent industry and all, it's not a very high growing, rate industry. It's just the company seems to be doing better than the market. And the last is the forex related risk, because the company does export. I think almost one third of the business comes out of exports. So for the surfactant business, again, the raw material cyclicity happens because of one more reason, because all the raw material for surfactant that is imported. So there is a raw material cyclicity, there is a forex risk, but somewhere because of that, there is one part of natural hedging also which happens because of this. Now coming to the technical, so as I said, I have a position. I took a position 2 weeks back. The reason I took a position now, by studying fundamentally, how the company is, has done historically, and from valuation perspective also, you got a you know picture, and the price has fallen from 560 to 300 just because there is some kind of relative selling which is happening, and in these kind of very small cap stocks. So these are the kind of stocks where sometimes I bypass technical, even if stocks look weak, not in momentum, because small caps, they can fall a lot even with a few crores of selling. So if one understands the story, has conviction, then I use technicals more to time my buys and all. And if you see this price, earlier till before 2021, this price used to be a resistance, you can see. But once it crossed this level in late 20, and then in early 21, the same level came to rescue and became a support. And after that, one to so this is a weekly chart, and so many times it has come as a support. So that is why the stock hit this area. I was very much interested and I built a position. So this is how we should look at this chart, and I don't know when it will turn around, when it will go into uptrend, but let's see. This is again a long term kind of position. By long term, I mean I'm willing to give it a 2 3 year time, and then when the right cycle is played, where the impact of new capex, when the impact of sales growth, when the impact of margin expansion, the impact of positivity, the market sentiment reflected in P rating, all of this happens, and the charts give some good up moves. That is the kind of journey I would like to have, and then when it tops out, I would like to sell at exit. So that is what we had on ultramarine pigments. I hope the presentation was useful, and do let me know if you have any questions. Let us know your questions, and we will discuss this either on YouTube if you are watching it on YouTube, or we will discuss it in one of our community meets, or you can put a question on our LMS. Thank you.